Test, test, 1, 2, 3.
Morning, welcome to the Real Assets Committee meeting for the Board of Investments. Sarah.
Recording in progress.
I'd like to go ahead and call to order, and as such, can you go ahead and have the roll?
Thank you, Mr. Jones. This meeting is being conducted as a virtual meeting and in person. So I will do a roll call of the trustees to confirm attendance. Mr. Jones? Mr. Green?
Present.
Mr. Kelly?
Present.
Mr. Santos?
Here.
Mr. David Green? Mrs. Jones? Ms. Sanchez? Here. Mr. Rue? Thank you. Staff participating in the meeting includes the following: CIO John Grable, CEO Santos Kryman, Chief Counsel Stephen Rice. Investment staff includes Scott Drazel, James Rice, Cindy Rivera, Dale Johnson. Consultants on site are Alborn, Stepstone Group, and the Makita Investment Group. Trustees, please use the raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak, and now we proceed with the agenda.
All right. All right, thank you. So we'll go ahead and proceed then to the approval of the minutes. Do I have a motion to approve?
Move approval. Second.
Okay, 1 second. Sorry. Santos Kryman made a motion. Okay. Mr. Jones?
Aye.
Mr. Kelly?
Yes.
Mr. Green?
Aye.
Mr. Santos?
Yes.
Okay, the motion passes unanimously.
Okay, thank you, Linda. And so then, do we have any public comment?
We do not.
Okay, great. All right. Well, I know we have a robust lineup of reports today, so we'll make way for those. And I imagine that we'll have my colleagues here will have plenty of questions related to it. So without further ado, let me go ahead and pass it off to you, Scott, to produce or Jim. All right, Dale.
Thank you. Good morning, Chair,
So
committee
close.
members, and trustees. We had one of four options. Beginning on slide 2, this report is a brief update on LACERA's work to make use of the Global Real Estate Sustainability Benchmark, also known as GRESB or GRESB, depending on your preference, as a tool to complement how LACERA is carrying out its investment policy statement to consider investment-related ESG factors in our investments. The objective is to update trustees on LACERA's GRESB affiliation and keep trustees informed on one strategy among several that LACERA is pursuing to operationalize LACERA's investment policies. I will quickly recap LACERA's approach to evaluating external managers on how they manage ESG-related factors and how GRESB fits in, including its focus on investment risks specific to real estate, such as anti-bribery practices, permitting and regulatory relations, energy efficiency, and tenant and community relations. Cindy Rivera will then share a few brief high-level takeaways from the team's review of the most recent GRESB reporting from our participating managers. Moving on to slide 3, LACERA's investment policy statement provides the framework by which LACERA manages all fund assets, including our approach to ESG. As noted on the top of this slide, the IPS formally recognizes that ESG factors may shape investment returns and provides that we assess external managers on how they manage ESG factors relevant to the mandate to achieve the fund's performance objectives. LACERA evaluates each mandate during both upfront due diligence and ongoing portfolio monitoring. The bottom half of the slide provides a snapshot of our assessment scale, which applies to all asset classes across the fund. The 5-point scale reflects our interpretation of the level of material ESG integration into each mandate. Scores on the left reflect mandates with no integration or are in the early stages of developing capacity, such as formalizing due diligence processes or finding data sources to manage ESG risks. As you move to the right on the scale, the more the mandate is able to provide compelling information that they have a comprehensive approach to manage ESG risks, set, measure, track, and report key performance indicators of factors such as health and wellness, tenant satisfaction, water usage, among others, and convincingly explain their approach, how that ties to the strategies, to the financial results of the strategy. The ESG integration assessment score is displayed along with other factors of each mandate, such as performance, fees, organizational quality, client service quality as part of the manager scorecard reported to the Board of Investments in the quarterly performance book, which is included in your board package today. It's intended to provide a holistic view of key factors on manager quality. Moving on to slide 4. Slide 4 provides quick background
Mr.
on
Johnson, through the chair. So the scorecard, I think is a great tool, but how are we using that if the score, as an example, of a particular manager is not up to the level that we expect? What's the process at that point?
Well, it's an overall evaluation. So we're looking at all 5 components of the scorecard, and that may be determine whether we eventually re-up with the manager, or there's other situations where maybe we're trimming the lineup or some assets or something. So that would be considered into various aspects of how we manage the relationship with the manager.
Good, thank you. I think it's important.
So LACERA's affiliation with GRESB provides a constructive tool to assess the evaluation of ESG integration of LACERA's real estate managers by supplementing LACERA's due diligence and portfolio monitoring as noted on this slide. To refresh and for the benefit of the newer trustees, GRESB was formed in 2009 by pensions and asset managers to develop a common set of reporting and benchmarking of ESG performance in real assets, with the evaluation criteria defined by real estate investors themselves. Asset managers report to GRESB in an annual reporting process and include various data and operational practices, such as those noted in blue, like how they manage energy efficiency. GRESB then compiles all the responses, creates peer groups and benchmarking, and makes the benchmarking available to participating asset owners, such as LACERA. These assessments provide valuable information and a view into managers' practices over time, generate insight into best and leading practices, and inform conversations with LACERA's real estate managers on their level of integration of material financially relevant ESG factors into the real estate investment process. LACERA encourages all real estate managers to participate, but does not require it. And as noted on this slide, 8 of LACERA's asset managers have reported to GRESB for at least the last 3 years, including a mix of both separate accounts and commingled funds. For managers who do report to GRESB, we review the manager's annual GRESB assessment results and discuss with managers the progression, insights, and perspectives. For today's discussion, Cindy will review some high-level insights from the most recent cycle of annual reviews with managers and how we can continue to make use of GRESB going forward for our fund diligence and portfolio monitoring of our managers' investment practices.
Thanks, Dale. Good morning, Chair Jones, committee members, and trustees. If we can move to the next slide, please. On this slide, we have an overview of LACERA's real estate portfolio's GRESB scores and trends. Notably, this slide has a lot of information, and I'm going to walk you through it. As stated in black font above the charts, LACERA's portfolio scored 77 out of 100 possible points on an asset-weighted basis. This is 2 points below and generally in line with the benchmark of peers with similar portfolios. Peers are defined as portfolios that are similar in risk profile, property type, and geography, without adjusting for differences in the total size of each peer's individual portfolio, meaning that large and small portfolios are considered peers if they have similar risk profiles, property types, and geographies. Moving down to the charts in the middle of the slide, we broke out LACERA's total score by the 8 participating mandates, half of which happen to be commingled funds and the other half separate accounts. The commingled funds are shown on the left-hand side and the separate accounts on the right. The charts on this slide show GRESB scores for the last 3 years, and the yellow circles represent each mandate's peer average for that year. You will notice that we anonymize the manager names, and this was done because GRESB reporting is only one component of the greater ESG score that is reported quarterly to trustees via the LACERA manager scorecard. We note that GRESB scores are helpful in comparing the manager's organizational structure around ESG and their ability to manage the related investment risk of LACERA-owned assets. When we view the data by account vehicle, we find that LACERA's real estate commingled funds generally outperform peers as well as the separate accounts. These commingled funds have on average more sophisticated approaches to ESG and have been reporting to GRESB for longer. Arguably, there is a learning curve associated with the ESG in general and GRESB in particular. LACERA separate accounts began reporting to GRESB in 2020 at LACERA's request, and they continue to make progress. The bullet points below the charts comment that the trend in scores over the last 3 years have been positive, with most managers making gains and several reporting that GRESB participation actually provides a roadmap to help identify areas of improvement. However, the relevant peer groups are also making steady gains, stressing the importance of continued focus by LACERA and its managers to avoid falling behind. The following slides are high-level takeaways after 3 years of participation in GRESB and staff's detailed discussions with managers over the years. On slide 6, we start by looking at the fundamental business risks and opportunities of ESG factors. From a leasing perspective, a building's attractiveness to potential tenants and thereby the rental rates that tenants are willing to pay are influenced by the building's ability to evolve and meet or exceed recognized best practices in sustainable property management. Statistically speaking, ESG factors are considered materially significant. Compared to market pricing, buildings that are not proactively managing ESG factors, maintenance, etc., are at risk of being subjected to what the market refers to as brown discounts on leasing rates. Buildings that are energy efficient and better at managing ESG-related operating risk may attract greater tenant demand and therefore higher lease premiums or green premiums, as well as greater tenant retention and lower tenant turnover. On slide 7.
Excuse me, Mr. Chair, if I may, just a quick question. Before you went on too far from the scoring and whatnot, I had a couple quick questions. The metric that they're using, this company, how many other funds are using this type of metric? I mean, it seems like there's a few different rating systems for ESG and whatnot. So, how many other companies, similar type of LACERA are using this company?
I think so. It's a global benchmark, and there's thousands of funds that are reporting to GRESB, like in Europe and the US, and adoption continues to grow. We're encouraging adoption because of the insight that we gain from it, but I forget the number is somewhere around 3,000 or 4,000.
It's pretty significant though. So it's everybody's talking the same language then.
Sure.
Right?
Yeah. Good morning, Mr. Chair and trustees. Thank you for the question. On the top of slide 4, we've got a quick bullet that there are 170 affiliated investors globally, both Europe, North America, Asian markets, and over 2,200 funds that are currently reporting to GRESB. GRESB it's a benchmark, so it's kind of ability to kind of look at scale on what different managers' approaches are to ESG. There can be other data ratings or data input sources that are also in the market. So there's kind of an ecosystem of data sources, ratings, and benchmarks. This one is really intended as a benchmarking service, and with 170 affiliated investors.
Gotcha. My next thing, as far as the commingled funds, it seems that it's a motivator. And how much of LACERA's influence is that? Because there's a significant point difference in the rating system. That's as a result of our philosophy, our direct input. Is that correct?
I'd say so, especially on the separate account side. They were not reporting prior to our encouragement. And then with the commingled funds, some had been reporting for years and some only started again at our request. So we believe our influence is being accepted and working with our managers. So you'll see in later slides, but we expect the number of participants to grow over time as well.
Gotcha. But do you anticipate any equilibrium between the commingled and the uncommingled, or because they're, or eventually, or probably there'll still be a difference, correct? I mean, just more participants.
Yes, I think you'll see more participants growing from the commingled fund side, and especially because of our structure review, we're actually making a significant shift away from separate accounts and towards commingled funds. So currently we have 5 separate accounts, and 4 of which are participated in GRESB. So I think the growth will come from the commingled fund side.
Outstanding. Thank you.
You're welcome. So on slide 7, we present what staff observed as the range of asset managers' sophistication and approaches to ESG. ESG is not a check the box exercise. Instead, we find a spectrum of sophistication. On the spectrum of capacity building to intermediate to leading, a lot of our participating managers are in the capacity building and intermediate stages, developing and implementing structured approaches to manage ESG related risk firm-wide and at the asset level. A couple of LACERA's real estate managers are at the other end of the spectrum, leading in their approaches to drive financial value at the property level, as well as transparency and reporting to investors such as LACERA. A key distinction between capacity building and leading is that the former focuses on developing basic policies and tracking and resources on a firm-wide basis, whereas the leading firms are able to evaluate and track data on each property, tracking utility costs, identifying areas of improvement, and measuring progress. With manager collaboration, LACERA will continue to steer its mandates to be leading and best in class. On slide 8,
Cindy,
yes.
real quick for you, if you don't mind. There's 8 or 9 other mandates that aren't currently reporting. Is that, I would understand that there's like 8 of 17 or something like that from the one
So
slide.
about 10.
So, and then the other 10, what's the division between commingled and separate accounts between the remaining 10?
There's really just one other separate account.
Okay,
The rest
so
are
there's-
commingled funds.
Okay. And then lastly, in terms of a time frame for influence with the other 10, what would you anticipate kind of the migration of the other 10 from a time frame perspective to be?
I think it'll still, I mean, just given that we probably could expect a couple every year. I mean, we're probably still looking at a good 3 to 5 years. But again, GRESB participation is not required. So there might just be still some funds that for various reasons would prefer not to participate, especially those that, for example, are later in the life cycle. Maybe they're in wind down mode. It doesn't make as much sense for them.
Okay.
But,
All right.
yeah.
Thank you for the clarification.
A key moment of opportunity is really in the upfront underwriting. So as the fund migrates to more commingled fund exposures, the due diligence process of asking if the mandate will participate at GRESB is a key moment of possible influence and discussion.
Oh, we're on slide 8, right? Here on this slide, we list several of the asset level strategies deployed by the more advanced and sophisticated firms that we referenced on the prior slide. These firms are really drilling down to granular property level strategies to manage ESG related risks in their portfolio management. First and foremost, data. The ability to access and track data is leveraged to increase intentionality in the management of asset level ESG factors, such as utility cost and energy efficiency. Green clauses refers to language in tenant leases to enable landlord access to usage data that is under tenant control. This is an effective but slow-moving tool due to the longer-term nature of most commercial real estate leases. Health and air quality factors and building certifications are expanding as well. Whereas firms have often signaled building credentials to tenants by focusing on certifications such as LEED and Energy Star, health and air quality and an overall concern with wellness has become more prevalent in building certifications since the onset of the COVID-19 pandemic. On climate, we note that although many asset managers have recently made public commitments to achieve net zero, we find their ability to speak to how climate pledges shape their portfolio vary significantly. Climate pledges by sophisticated firms are supported by detailed multi-pronged approaches and, most importantly, data to generate sustainable value and proactively improve property level energy consumption and emissions via operational costs, capital expenditures, renewables, and offsets. On slide 9, this is our concluding slide in which we share next steps. For LACERA staff, GRESB assessments have been a useful tool to better understand managers' deliberate actions to manage property level ESG operating risk and how such compares to peers. We will continue to engage with current managers and monitor progress. We plan to expand and integrate use of GRESB by accessing GRESB reports when available, to underwrite future commingled fund commitments, as well as use GRESB in the real assets portfolio. GRESB has a similar benchmark for infrastructure managers. For increased transparency, we plan to continue to fold in periodic updates to trustees as part of total fund ESG strategies. This concludes our prepared remarks, and we're happy to stand for comments or questions.
Thank you.
Kelly,
Thank you.
looked at a question.
Thank you, Cindy, for your report, and thanks to the team for your efforts here. My question is, it's still at the end of the day, it's still all self-reported data. And as we see in other initiatives here, it's probably, as some would call it, greenwashed. Do we ever get to a point where we institutionalize, for example, compliance reviews or audits of this information so that we can know it's solid?
Thank you for the question, Trustee Kelly. You're correct that there's a question on data quality. So one challenge is getting to data, as Cindy has highlighted. The more advanced firms are tracking individuals' kind of data utility usage, so forth. But it has now been built into the GRESB benchmark of, is that data verified or audited? Is it verified or audited by external parties or the independent, so forth? So by having a benchmark that's informed by, investor sentiment, that has been built in, and firms will score better the more that data is verified and accounted for. So that you're spot on the trend line of where the industry is going.
Any other questions?
Yes.
My colleagues?
Yes,
go
thank
ahead,
you.
Trustee.
Just to follow up on Mr. Kelly's question. So we do, in these relationships with the commingled funds, well, it's particularly in the commingled funds. I mean, we do have a representative at the committee, the investors committee. True?
The LPAC?
The OPA, right?
Yes, that's.
And as being members of that committee, which I'm sure some of the staff who are here are part of, that information that Mr. Kelly was referring to is also review. Is that true?
Good morning, Mr. Santos. Morning, Mr. Chair and other trustees. We do have membership on many of our commingled funds that we invest in. And often that's the case where ESG data might be reviewed, but it's not always the case, I would say. But I think it's something that we typically look for if we're not getting good data directly from the manager as part of normal ESG reporting, to have them share it through the LPAC structure.
And
I'm sorry, go ahead. Go ahead.
Regardless if the manager is participating in GRESB or not, in private markets, we're seeing more managers start to provide basic core metrics, either to the LPAC or to the annual meeting or an annual portfolio company reporting. And that information is getting more granular. There's kind of more convergence on kind of key points. And it's part of our upfront due diligence, as well as ongoing monitoring of understanding, not only what the process is of integrating ESG, but what transparency or reporting will the manager provide to LPs going forward. But there too, kind of a point of influence is really in the upfront due diligence. For some of the legacy funds, managers have indicated that it's more difficult to develop the data structures in their portfolio holdings in real estate. So they may begin to report to GRESB for the next fund sequence. So I think that there's an evolution that we're witnessing in real time, and by engaging them in the discussion, we can perhaps prompt more transparency in reporting.
Right. So in terms of the validity of the information that we're getting, we do have the opportunity to evaluate with regards to the monitoring of the particular fund, as well as being members of the ILPA committee. And certainly we can request that information. So we should be relatively confident that the information being provided based on all this monitoring, it should be adequate or valid.
I would say in Mr. Santos that the information is expanding. So kind of a question of adequacy, could be in the eyes of the beholder.
I'm sorry. I was talking about with regard to the validity of the information, because the question was how we know, if I understood it correctly, how do we know that the information being reported is accurate? That's the word, accurate. The accuracy. You understand what I'm saying?
Yes, I appreciate and, concur with the point. And in some areas for ESG reporting, I think there's a sense that we don't want perfect to be the enemy of the good. So just starting some reporting allows for investors to assess the information, perhaps probe quality, if methodology isn't fully developed in some areas of scope 3 emissions, for example, it is still reported without fear of legal liabilities necessarily, so that investors can make use of the information. But then as methodologies tighten on some metrics, develop the systems by which that data can be verified or accounted.
And through the chair, Mr. Phillip, any comments with regards to the discussion that we're having here in terms of the validity of the information? What's your point of view as a consultant?
Yeah, I think Scott's most recent point, the data is evolving, right? This is sort of new territory. As more organizations focus on ESG, they're going to be monitoring and managing different things. So it's different data sets, different reporting metrics off of different property types. Integrating all of that's just going to take a long time. And as far as the validity of it, yes, most of it's self-reported at this point in time. There will eventually be audit mechanisms, but I think you have to get the landscape more robustly developed before you would build in kind of those other processes on top of it.
Thank you. Thank you.
Any other questions by my colleagues before we move on to the next report? All right, Jim, Scott, and Dale and Cindy, thank you very much.
Thank you.
Thank you.
Good morning. The next item is a report from our consultants, Stepstone Real Estate Group. We're joined by Tom Hester, who's been invited to prepare a presentation on the performance of our real estate portfolio, as well as some comments on the current market conditions. Just as a reminder, we engaged Stepstone as our consultants to advise us on real estate just 2 years ago. And Tom will take it from here.
Great. Thank you, Jim. Good morning, Madam Chair, members of the committee. In the interest of time, I'm going to skip a few slides, but let's start on slide number 1. Here you go. Just give a recap on the current state of the markets. Our view, Stepstone's view, is that the US and Europe will face higher for longer interest rates amid slow growth and persistent inflation, and Asia Pacific is expected to lead growth, economic growth, with Japan maintaining lower interest rates and China reopening in the post-COVID period. On property sectors, industrial continues to benefit from the secular change in the retail supply chain, and rental residential across all formats now, which include build to rent, single family homes, horizontal build to rent, which are like townhomes now that we're seeing, attached housing, specifically for the rental segment of the market. And we also think that the affordable end of the market will continue to be attractive. Certainly, this country has been underhoused for decades now, and with rising rates and home affordability decreasing, we will recommend focuses and allocations to the affordable end of the rental segment. On strategies, there's a slide I'll show in a minute. It's all about funding gaps. Secondaries and recapitalizations will fill those funding gaps and will allow really good sponsors to keep assets and complete business plans. This will allow for selectivity to partner up with best-in-class managers and good quality assets. The simple fact is today, a lot of unpleasant things are happening to some really good people out there, given the capital market conditions and the lockup in the banks. So we think that, distress-oriented buyers will capitalize on motivated sellers who cannot manage those gaps. Let's skip to slide number 3. It's 3 in my deck. I think it's 1 up. Yeah, this one. I wonder why that's okay. This is very problematic, and this situation continues. There's a valuation discrepancy. In 2022, the public markets, as one would expect, corrected for the most part, fully on distressed conditions of both the capital markets and transaction activity. If you look at the upper part of the diagram here, you can see third line down that the US public REITs were off 25%, which is probably full valuation decrease for the year. If you look down one portion of the chart to the commercial property indices, which are based on transaction activity, Green Street was off 13%. Now, that's a little skewed because there were not a lot of transactions, but those that did take place, Green Street is reporting a 13% decrease for 2022. Now, here's the problem. If you go one down, look at the core fund indices, look at US NCREIF Odyssey. For the year, it was up 6.5%. And most of the write down that occurred was in the fourth quarter, which was off 5%. You know, the Odyssey group is, for the most part, advised by Altus, which is an accounting shop that acts as the consultant for most of the Odyssey funds, but they don't provide the individual MAI appraisals that are performed on the assets. Those are done by local shops. They wrap their evaluation opinions, they send them up to Odyssey. Odyssey kind of, they kind of weight test it, they sniff it out. They might change an assumption or two. They look for math errors and they bless it. But this is a reckoning period for Altus because it's just not acceptable. If they're an advisor to 94% of that market, which is by far the largest segment of the core market, they need to increase their representation. In our view, we're putting pressure on them through NCREIF and the Real Estate Reporting Standards Committee to start wrapping opinions around those valuations because they're just not right. In fact, it's quite ridiculous, but it's interesting because Altus also does valuations for the open-ended debt funds, but on those, they provide a full USPAP MAI appraisal, and they in fact put their opinion on the NAV. But for the equity market, they just kind of go, we think it's okay, or, we're not going to really stand behind it. They bless it and they move it up. That's a reckoning, as I mentioned, and StepZone is active in pushing them to change the scope of their agreed upon procedures. And then the last one here, you can see the very bottom, the non-core fund indices, Burgess still has a ways to go as well. So valuation continues to be a problem, how it's reported. And we think that some of that is also evident in the portfolio that LACERA holds, particularly in the IMA assets on the core side of the spectrum. Let's go 2 slides up. Next one. We have a problem because my deck is different from this one.
I think these might do. Could you advance one more, Inga, please? No.
Yeah, let's just let me just talk through something. There's so I mentioned a moment ago that there's a funding gap. If you look back, you don't have this slide. Apologize for the mix up here. 1 year ago, a stabilized multifamily property, Class A multifamily property valued at $100 million could have carried a debt load of 75 million. And that's 75%, of course, loan to value ratio. But the way that banks and lenders typically size their debt is based on the debt service coverage ratio. What's a percentage of cash flow that will cover the debt service payments? That loan a year ago at a 2.8% interest rate, cost of debt, would have been a 2.2 coverage. So if you flip to today, we know that valuations are down. And if you look strictly on an LTV level, that same asset would probably only support about $56 million in debt, not 75. But if you look at the debt service coverage ratio, which is the main test, that asset would only support $34 million of first mortgage financing today, leaving a funding gap of about $41 million. That's the opportunity in this market. That gap is going to have to be met. There's $2 trillion of mortgages that are maturing over the next 3 to 4 years that are going to have to be dealt with in some manner. Some of that will come back. The banks are trying to push that away, but there are private debt funds that will have to, also, figure out what to do with those assets, either push them back to the borrower, recapitalize them, work with the borrower. Right now, we're in a position where you have a borrower, the first mortgage lender, the bank or debt fund, and a mezzanine player, and they're all kind of pushing the keys back across the table, but for some assets that are just lost causes. And we've seen some of those in downtown LA and some of the office towers in that segment of the Southern California market. I'm going to skip some of these other slides and go right to performance. Keep going right there. What I would say here, overall portfolio, if you look at the column, the first column on the left after the descriptions, inception to current quarter, the net inception to date IRR, the DPI, and the total value multiple, which is equity multiple, just continue to remain collectively too low. This is not surprising. The recent strategic shift to increase allocations to non-core risk is underway, as is the slower, currently disrupted process of shedding IMA assets in favor of commingled funds. In normal conditions, we would have been about a year into that process. As we all know, the RFP was approved. We're going out, we're looking for brokers to help facilitate that process, but we're still several quarters away because we need valuation. We need to know what we're going to get out at. We want the valuations to recover. Some assets, they might not fully recover, but we have to go asset by asset, portfolio across all IMA assets, figure out how to pull them, what can be sold now because there's no accretion left, what can be, further, have a further accretion of value into the asset, and those that are ready to sell now. Process is underway, we're behind. I'll skip to the core versus Odyssey slide, one more. Okay, in SRE's opinion, as I mentioned, the portfolio's current valuations are not reflective of transactionable value today. They need to come down. And in the current quarter, they are probably okay. You see, we're only off, or actually we're better than Odyssey by 20 basis points. I think that's probably okay because the Odyssey has more office exposure. And the LACERA portfolio is currently underweight to office. That helps, but from 5 years to 1 year, and they still reflect, the valuation of the portfolio still reflect a core run-up that is largely getting wiped out today. And we need to take a look at those valuations and push our IMA managers to get realistic on their marks. If you go to the next slide.
Before you leave this slide, may I ask a question? Yeah. So notwithstanding your comments on the fact that the IMA managers may be behind on marking the books, how would you characterize the performance of the IMA relative to the sort of commingled portfolio that we have? How can you talk a little bit about the difference in terms of exposure and performance results for that are kind of that we can and should expect, and how much, if you can hazard a guess, what kind of valuation adjustment is going to happen between now and the time we sell the remainder of the IMA portfolio?
Start with the first one. I think that the core portfolio in Essentia still reflects inflated valuations. So I think on paper, they look like they're outperforming the non-core segments of the portfolio. But I think that the recent shift, strategic allocation to commit roughly $4 billion over the next 4 years, we're still in the J curve there with most of those allocations. However, for a core asset, at a 3% cap, if the cap rate goes to 4%, that's a 33% reduction in value. For a non-core asset, if it goes from 12 to 15, that's only a 25% reduction in value. And there's more headroom to accrete value into the asset. So that's what we're monitoring. We're looking at that closely. But right now, I would say it's a little difficult in pure numbers and metrics because of the J curve impact. Okay. How long will it take? Really?
I get it.
Yeah,
well, the point of sale
I'd
is
say
the point at which you know what the value is.
3 to 4 quarters out, I'm hoping that we're transacting. Yeah.
3 to 4 quarters out. I'm sorry.
Go ahead.
Can I just jump in with one? Maybe to summarize it a little more concisely, of that outperformance in the 1 year number that you're seeing, is essentially all of that attributable to the separately managed accounts, which have this sort of phantom valuation problem, or are there other drivers in that performance? Because when you look at this report, you think that it's really strong, but then the narrative doesn't quite match what's on the paper.
I think significantly that's the issue. Yes.
All right. Did you, trustee?
No, I was just gonna say that, while you comment, it's gonna take, I think you said 3 or 4 quarters for us to get to where we want to be. Well, we were conscious of that when we decided to change the strategy. So it appears to me that we are in better shape now, moving into the new strategy, the commingled funds, and getting away from separate accounts, which caused the underperformance of the portfolio for many years. So we just have to be patient.
Yep.
And move forward. Just keep the eye on the ball.
Totally agree. I think that when we initially said 3 to 4 quarters out was when it was approved, but we're a year behind. That's why I say now another 3 to 4 quarters because of a lockup in the capital markets and transaction activity. So that was
Tom.
Yes.
I'm sorry. Real quick question. So in that 3 to 4 months, quarters, excuse me. Thank you. What is it that we're anticipating beyond just time that will improve the environment for what we want? Because part of my, again, I'm not a deep real estate person, but part of it is there's anticipation that as the economy slows, that you might see some more stress and you just might see some more bankruptcies, which means occupancies of companies, particularly in office and other areas, may further put stress on those who already have meaningful office component to their properties. What is it that you are anticipating from your experience that over the next 3 or 4 months will yield the improved conditions that we're kind of anticipating?
Number one is valuations, a reckoning on valuations. Number two would be the banks opening back up and starting to lend again. A normalization of interest rates. It's interesting because apart from office and work, I mentioned that a lot of unpleasant things are happening to some really good assets, really good people. No one saw that coming. And if you had an office asset, most institutional portfolios were office centric. That was a linchpin of any strong portfolio. A CBD Plaza office building in downtown San Francisco was gold. That changed after the pandemic. So I think that apart from office, which will continue to go through significant changes in the way it's used, some markets will be fine. I think, Midtown New York is going to be fine. Downtown New York City will be fine. San Francisco, I think, is 7 to 10 years away. Century City is cranking and doing very well. Downtown LA will always be a ghost town. It just is. That's just a simple fact. It's 70% occupied. Rents never grow anywhere. It's been that way for 30 years. I've lived in LA my entire career. It's never changed. The question for those guys is, why exactly were you investing there in the first place? Some big firms that, took a big bet, one in particular, and it was a mess. And we could have predicted that. So anyway, I think that apart from office, because there's going to be a sea change there in how it's used, some will be convertible into multifamily. That's not an easy task. It's very expensive today. And it's only going to be prevalent in, well, the good thing is obsolete office, but it has to be, no more than 50, 60 stories. So, and not large floor plates. So you can create a light well in the middle. Mm-hmm. So you can have light to all of the units. So floor plates are too big now, to just take an office use and convert it. That's going to take time. The price will come down, of course, as more activity occurs there. But I think it's just so the point I was getting to was, apart from office, operations and fundamentals are still relatively strong. Okay. Rent growth is muted and leasing activity is a little muted because of, uncertainty in the general economy, but operations are still doing okay. The problem is your cash flow at 3 times the debt service costs isn't getting you to the same level of financing and return on your equity that it was 3 years ago.
Got it. Okay.
Let's go to the next one. I'll just talk quickly on value add. I think here that the value portfolios comprise mostly of, more recent vintages. So the pattern here is not altogether surprising in terms of the pronounced J curve in years 3 and 5. And like the core portfolio, we think that the valuations are not really reflective of market pressures. But again, we're still adding value. These assets are being they're under their business plans now, they're being converted. These business plans will take longer. We understand that. And capital deployment actually in the ground into assets will take a little bit longer. But I think that by and large, we still really like the more recent value add funds that we've invested in. We think that they have the bandwidth and they have the discipline to ride this out and make some significant and accretive investments for the fund. And yeah, so that's what I'll say there on value add. And then the last segment of the portfolio, opportunistic, which is looking okay in terms of overall returns, but since significant capital has more recently been committed, we expect that the net performance for the opportunistic segment of the portfolio will greatly exceed Odyssey plus 300. The current quarter is good since Odyssey valuations have been more significantly impacted. And we this is probably the one segment of the portfolio that we feel the best about today. And this segment of the portfolio is growing with the allocation increase approved last year.
All right. Any other questions?
That concludes my comments.
Thank you.
Yeah, so, we do have some holdings in Europe. So how is the real estate market looking in Europe?
Well, it's interesting because we thought that the US was going into a recession 6 months ago. Now I'm not so sure about that or prolonged recession, but we feel the opposite about Europe. We think that it might be going into a recession. Office there is significantly impacted. I don't think to the extent that it is in the US, and Asia is looking good in that respect because people never really left the office. We like Europe, but we wouldn't do core investments there. We think that segments in the non-core that reflect rental housing or residential, we like storage in Europe, and we like some certain entity financings for platforms. We think that that Europe will largely mirror the US. You want to stay away from office. Logistics is still doing strong, and retail surprisingly is doing very well in Europe, and not regional malls. Regional malls are, a dinosaur, but there are certain fortress anchor centers that are doing well, and like grocer anchored and convenience retail in Europe is still doing very well, which just a few years ago wasn't even a segment of the institutional market. It was regional malls or, power centers, or that was pretty much it. But that segment for necessity retail at the local level is seeing institutional capital and continuing to do well, particularly those that have ethnic grocers. Ethnic grocers are for the large part owned by public companies in Mexico or Korea, operating here, or by private equity shops. So it's very, very good credit, and they attract really good satellite tenants to those centers. Oops.
So you mentioned Asia. Is that developed Asia or emerging markets Asia?
Asia for us is Japan, China, and Korea.
China.
Yeah.
Okay.
China, China's reopening from COVID, and the growth story continues there.
Okay. Any other emerging markets looking good? Latin America? Africa?
Not in this environment.
Good to know. Thank you.
Thank you.
Any of my other colleagues have questions before we bring up the next presentation? All right, Tom, thank you.
Maybe just one.
Go ahead, Tim.
One more on our deck in slide 11, the one that has sort of the individual listing of the assets. Yeah, that one there, I think looks good.
Yeah.
Just on sort of answering the why a little bit on the performance, it might be helpful to also see the ones that maybe are the 5 worst performing, and if possible to separate them out by what's in the commingled fund, so that we over time can track the progress of those newer investments versus the IMAs. Because as we're going to have to contemplate portfolio sales, et cetera, it would be nice to be able to identify where we're thinking about transacting and what's causing, the good performance that we may see, whether it's phantom performance or not. But to get the why, you also need the other side of the equation, which is
it's a good point. We were noticed that we may get that question, so thank you. Mm-hmm. We're going to expand the report. We're going to give you some proprietary reporting that shows you in the current quarterly report you get, there is a vintage year table that shows the investments made in any calendar year. We can make it fiscal or calendar, however you want. But that's just all investments, whether they're commingled funds or IMA assets. We're going to break that down by type of account and by risk category as well. and we can bring it, we would take it down as far as you want. We could even do it by manager. Yeah, so we're, that may be a quarter or two away, but yeah, we're developing that.
All right.
Starting
Yeah,
yesterday.
Thank you for the clarification, Tim. Thank you, Tom.
Okay, thank you.
All right.
Okay, thank you. So thank-
Alborn is coming up.
Yes, thank you, Mr. Chair. The next item we have scheduled is the performance review provided by our real assets consultants, which is Alborn Partners. We're joined by Mark White and Jennifer Young. And they're intending to discuss the performance of our real assets portfolio, excluding real estate. And I realize we have 6 minutes scheduled. I don't know if.
Yeah,
if
I just was going to give a heads up to those who may be plugged in that I imagine this may be have quite a bit of questioning from my colleagues. So I want to make sure we have adequate time to do so. So just as a head up to the chair,
We
Yeah.
we can have the
maybe a 10
the
minute
meetings
delay at most.
15 minutes
Okay.
later, so give you some time.
All right. So thank you very much. Go ahead, Alborn.
Thank you.
In other words, this is very important to us.
Thank you. We agree.
Thanks, Jim. And good morning, Chair Jones and committee members. Mark and I will be providing a performance review for the real assets X real estate portfolio, which is currently comprised of both public and private investments. Can we go to slide 2, please? The performance summary chart on top highlights the portfolio's performance by category over different time periods, which we will go into in more detail on the following slides. At a high level, we'd like to highlight that the portfolio is relatively nascent, still largely comprised of public securities, with most of the private investments being made in the past 2 years. And so the J-curve impact has weighed on returns. Since most of the private investments don't yet have 3-year returns to report, the most relevant performance to highlight is the since inception returns of the portfolio. Since inception, the portfolio has delivered positive performance of 3.6%, and in addition has provided diversification and income to the overall plan in what has been a volatile market environment. In the bottom right is the portfolio on a NAV plus unfunded basis, which takes into account the commitments LACERA has already made to private natural resources or infrastructure managers and better reflects the projected composition of the portfolio. Relative to the policy target, the portfolio is slightly overweight infrastructure and underweight TIPS. Moving on to slide 3. The pie charts highlight public securities are projected to decline from 72 to 63% of the portfolio on a NAV plus unfunded basis as capital commitments are drawn down over time and the focus continues to be placed on building out private real assets exposure. Now on to performance, starting with infrastructure. Over the past year, public infrastructure delivered returns of negative 8.1% as infrastructure funds were not immune to the impact of rising rates and concerns over slowing economic growth, both of which weighed on security valuations. But the sector fared better than the MSCI World Index, which was down double digits, highlighting the defensive characteristics of the underlying assets, as well as inflationary benefits that these assets provide. During this period, LACERA's return underperformed the benchmark primarily due to sector allocation within its core holding, particularly an overweight to North America communications, a sector which lagged due to the broader sell-off in technology and disappointing earnings outlook for the sector. This was slightly offset by the manager's stock selection, which contributed positively. Similarly, portfolio returns lagged the benchmark in the first quarter of this year due to poor sector allocation. The fund was positioned more defensively in an environment that favored lower quality growth stocks and underweight European transport when Europe was the strongest performing region in the quarter. On an absolute basis, return was positive as stocks broadly performed well for the quarter, lifting infrastructure stocks as well. On to tips. Despite inflation being stubbornly high in the past 12 months, tips delivered returns of negative 6.6%. This is primarily because of the Fed rate hike cycle and the speed of the rate increases resulting in higher real rates, which had an inverse impact on the price of tips, resulting in negative returns. Conversely, in the first quarter of this year, tips generated positive returns as inflation and the market's expectation of inflation were priced, started to price the nearing of the end of the Fed's rate hike cycle, and in turn, lower interest rates. So the real interest rates ended the quarter lower than at the start of the quarter, resulting in a positive return. Finally, natural resources and commodities. Over the past 12 months, directionally, commodity prices were pressured by the strong US dollar, and in particular, energy prices were weighed down by recessionary concerns. And similarly, while global equities largely ended the first quarter with positive returns, commodities again were weighed down by recessionary concerns and declined, resulting in a negative return. LACERA's return trailed the benchmark as its largest holding is primarily comprised of equities, which are higher beta than underlying commodities. With that, I'm going to pass it on to Mark, who will now share our observations on the private investments.
Jennifer, I have a quick question for you.
Sure.
As it relates to the commodity, is there a loose correlation to the expectations about China? I know people had expected China to have reopened more robustly, and that's put more pressure on commodities, kind of increasing price. Is there a China link at all to the underperformance in the near term, or is that?
Yeah.
There is a tiny link to it. Commodities over time has become more of a political vehicle as well. That's what we've seen in the energy complex with what we've seen from the OPEC plus reducing production. The metals component tends to be more closely associated with demand in China, and the global agricultural component of commodities, again, is based on the global sustainability and the health of our population. So what we've seen over the last 50 years in commodities is a little bit of a decoupling, if you will, from traditional measures because of more geopolitical influences associated with the asset class. So the volatility has subsequently increased, but its importance has not been diminished at all.
But if I may, Mr. Chair,
absolutely.
just to follow up on that, but when we look at copper and lithium, I mean, those two metals are in high demand and will be in higher demand in the future, going the shift to EVs. You agree with that concept?
I definitely agree with that concept. And one of the things with respect to commodities, you have to understand the commodity index. They tend to be cap weighted based on capital flows associated with it. So most of the broad-based indices are heavily tilted towards the energy complex and oil and gas simply because of the value of that asset. When we're looking at building a portfolio for LACERA, we're looking at the subcomponents of the commodity complex and its importance. You're not dealing with $1 trillion portfolio, which is essentially the commodity universe. You're dealing with billions of dollars. So you can be more focused and looking at the natural resources area in a more fruitful and forward-looking perspective. Thus, your natural resources focus on agriculture, hence fruitful, and the mining sector, the metals, lithium, copper, nickel, camdium, etc.
There's a lot of lithium in the Inland Empire.
Sorry, Trustee Green, did you have something?
Just agility. It gives us agility.
All right, thank you. Go ahead. Mark. Jim.
Okay, I'd like to go to slide number 4 because the performance numbers and the indices are important, but a real asset portfolio also has other objectives. One of the objectives is basically to have a lower correlation to your broader equity markets. Another objective is the inflation sensitivity and income generation. So real assets has this unique characteristic. So it's important that the board understands the subcomponents of the portfolio. So on number 4, what we're showing is the profile of what we refer to as the private infrastructure core. So this is an important part of what we see in the evolution of the portfolio. These assets are basically funded by the public assets that you have in the portfolio now as they draw capital. The public assets have a higher correlation to the broader equity markets because of the systemic risk associated with the areas. So the one thing I want to draw your attention to on this slide is basically keep in mind the word core. The contributions have been almost 940. And what we've now seen is unrealized appreciation of 23. Remember that number. Also look at the unfunded commitment. You'll see that 3 of the strategies are fully committed. These are your open-ended infrastructure strategies focusing on core, a very important base of your whole portfolio. This is an area that has high inflation sensitivity because these are your essential services, water treatment, etc., that basically have the ability to absorb and flow through inflationary to the ratepayers on the other side of it. Now, if we go to slide number 5, this is another component of your portfolio. So this is the private infrastructure, non-core. Look at the unrealized appreciation. You'll notice here that $53 million is unrealized appreciation. Yet the portfolio size itself is basically 1/3 the size of your total infrastructure. This side of the portfolio is what we call the barbell, is designed to grow. So these are growing infrastructure assets that the demand is increasing at a point in the future. Very different profile than what we have in the core. Less inflation sensitivity in this part of the portfolio, more GDP sensitivity. The better a community is doing, the more they draw on these types of infrastructure services. Therefore, the growth is a good element associated with it. If we now go to, I know this is time, so I'm really going to be rushing through. If we go to the next slide, this is another characteristic. One of the things that we break down, and I've always said to the staff and the board, is it's not the number of relationships you have, but it's the characteristics of the assets within those relationships. So one of the things that we do is we break down and we look at the characteristics of each of the underlying assets in the manager's portfolios and how that reflects on the objectives of LACERA. So if you look at the private infrastructure based on the sector component here, you'll see a very heavy tilt towards renewables and utilities. This is basically one of the faster growing areas in the infrastructure spaces. We've all seen California is a great example of that. The adaptation of renewable power sources is an important part of our component. But we also see other components such as social infrastructure, energy, midstream, transportation, water, etc. And note digital infrastructure. This boardroom meeting, the fact that it is able to be held at 2 different levels is an indication of the importance of digital infrastructure to us. The other thing is Los Angeles County's exposure is US-based exposure. So we want to make certain that the portfolio has a strong exposure to what's happening. Infrastructure has 3 separate characteristics when we look at it from a geological perspective. We can look at it from international exposure, global, and assets, say the shipping port, the port of LA. It's important what happens in North America, but also important what's happening in Asia. Or you can look at a regional water treatment plant, who's really concerned about the growth in LA County itself, because that's where it services. So when we look at the exposure and how that breaks down, we're very interested in understanding what LACERA's objectives are and how these assets help you meet those objectives. You also see, as I mentioned earlier, 72% in core and 28% in non-core. So that's the barbell approach. We are still building out that non-core component, but that's largely because these managers are not open-ended strategies and typically take 3 or 4 years to draw the capital and put the capital to work. This portfolio will become more imbalanced at some point in the future as we see that capital going.
Jim, so a question for you before we get there. Energy transition, would that fall under other Or is it kind of loosely locked into renewables? Like,
It's loosely locked in renewables, a little bit in utilities. Energy transition is a emerging sub-strategy. When you look at the complex that has been going around that, it will be seen very much as traditional infrastructure at some point in the future. But right now, energy transition is everything from hydrogen technology development to batteries to renewable assets. And it's all kind of been thrown in one bucket. And one marketing spin, as earlier was mentioned about the greenwashing, just about everybody that could put energy transition in their title is getting traction with respect to institutional pensions.
yeah, because I'd be curious to track the kind of brown to green subcategory in there as I kind of understand under energy transition, taking older assets and then over some time kind of retiring it at one level while at the same time improving its draw on renewable or green resources through there. I'm just curious to what your thought is on that and where we might be able to kind of monitor and have our portfolio kind of account for those opportunities. If you
We are very active in that, and LACERA is not alone in asking those questions. So it's a great thing that a lot of American institutions are asking that question, and European institutions as we move forward. The reality is energy transition is a marathon, and there is value to investing in assets that, for example, transition coal to natural gas. That is a transition in itself. And at some point in the future, transitioning that natural gas to, say, solar. So we have to take these steps, and these steps are going to take decades. So we are tracking when we look at the GP portfolios, every investment, we measure across a number of metrics. And one of the metrics is basically the impact on sustainability, environmental assessment, carbon footprint, and those things. So we are looking and tracking that. We have the capability of reporting that to Jim and his team.
Thank you very much, Jim. And I appreciate the pace, but also I know it's important. So I want to make sure that we're not stressing you out overly so as you try and sprint towards a finish here. So,
No problem here. I can go very slow or very fast, as Jim would know. Okay, let's go to the next slide, because this is really where the rubber hits the road for you guys. So basically what we're looking at is how the portfolio, and what this does is we map all the managers and all the positions, and you can see these are the current assets in your portfolio and the GPs. One of the things that we do is we don't take the GP's word for what they say they are. So if a GP tells us that their core infrastructure, we basically model all the assets and we determine whether they're core infrastructure. So this is based on our proprietary approach of modeling the portfolios. But you'll see that you have 3 core positions, and you can coordinate that to the slide previously that were fully allocated. These tend to be your open-end strategies. And you can see your opportunistic, the other end of the barbell, if you will, taking advantage of that. You'll also see in the triangle risk map, basically looking at your greenfield, your non-development exposure, and the demand-based assets in your portfolio. Remember, I mentioned inflation and GDP sensitivity. Well, demand-based assets are essentially assets that you utilize on demand, where availability-based assets are like your water treatment plant. It has to be there no matter what. Everybody will still flush their toilets. Okay, but everybody may not use a toll road if we are not moving into the offices or the economy is slowing down. So you'll see here that basically you have very low exposure. Less than 20% of your portfolio is exposed to demand-based assets. So it's an indication of high inflation sensitivity, lower GDP sensitivity. Remember the construct of your developed portfolio, your non-core infrastructure versus your core infrastructure. So I want to move on to the next slide very quickly, because this is the other side of your portfolio. So this is the agriculture component or the natural resources component that you have. So again, higher inflation sensitivity in these assets. So this is the agriculture component. LACERA has been able to take advantage of some secondary markets to help build out this portfolio. This has been very beneficial. But again, the important things to look here is the unrealized appreciations and basically the contributions that have been made in this portfolio. Appreciation in agricultural assets tend to be tightly linked to inflation and the health of a local economy, i.e. the better the middle class is doing in the United States or indeed around the world, the more likely they are to improve their diets and therefore be beneficial to the agricultural complex. Moving to the next slide, because the other side of it is now the mining component. Mr. Santos, to your observation here. We have made an active decision to pursue and look at mining opportunities to benefit from the greening economy as we move forward. The interesting thing about this slide is the capital being called into this, or the unfunded commitment component, is still quite robust. So going through this dislocation that we're currently seeing with respect to the commodity markets and the recessionary environment that we're potentially entering into, most of our GPs have a lot of dry powder to take advantage of opportunities and position their portfolios going forward. Okay, the last slide here. Oh, this is just the mix of the portfolio composition. I'll just quickly go over to this because the last slide is actually the most important slide in the interest of time here. Go to the next one, please. So again, meeting those other objectives. Are we meeting those objectives? Well, the star here is LACERA. So what this chart basically indicates is the beta exposure that you have to the broader equity markets. We ran this beta analysis based on the maturity of the portfolio. So when you started down your real asset portfolio relative to what we're seeing in the third quarter or the first quarter of 2023, you'll see that basically your correlation is just less than 0.6 to the broader equity portfolios. And you'll see the S&P 500, you'll see also core real estate, because the objective of real assets X real estate is also to have a lower correlation to your real estate portfolio. But correlations are great. You also have to look at the performance profile associated with that, which is basically the time weighted returns, just slightly less than 6% on the portfolio, but this portfolio is still evolving. Part of that return profile can be attributed to what occurred in the liquid component of the portfolio, which had a higher systemic risk to your broader equity markets. Your illiquid component of the portfolio has exceeded this performance target. So the objective going forward, you will know if your portfolio is doing what you want it, is if this star moves down and reduces its correlation to the broader equity markets and moves to the right and improves its performance profile to achieve the minimum return requirement. That's how this board can track if the real assets team is doing their job.
So lastly, just to be clear, the kind of nirvana spot is basically where private lending is.
Trying to get down towards private lending. The key trick there is we also want to maintain a low correlation to the to the credit markets as well. With this, in the interest of time, we chose to focus on the equity markets because the liquid part of your portfolio has been a part of your performance profile story.
Okay. All right. Colleagues.
Yes.
Yes. Trustee Santo.
So typically we want to give the nascent strategy of ours 5 years full market cycle. True? Is that?
Typically, you want to see a full market cycle. Real assets work best once they've seen an inflationary component, as we're seeing now, but also seeing how it responds to a rapid growth cycle coming out of an inflationary recessionary period where we see renewed growth in the economy. We want to be able to keep up with that market, but not necessarily parallel that market. Again, what happens with most real assets, there's typically a ceiling, if you will, on performance. If I have coming back to the water treatment plant, I will have a contract with the County of Los Angeles that ensures that I get about a 8.5% return on my profile. So if the capital markets go up 30%, I'm still only going to be getting my 8% profile because I can't force people to flush toilets more.
So given the inflation that we're going through right now, interest rates, when we look at this chart that we have in front of us, can we extrapolate from here and determine how well the portfolio is doing, let's say in a full market cycle of this strategy? Where are we?
You're doing quite well because each subcomponent of the portfolio has performed as it should have. For example, the real estate portfolio did quite well. Or not the real estate, sorry, the agriculture portfolio had performed quite well. And part of that was the big catch up in the inflationary component of row crops. Row crops have had a great year in the last 2 years, reporting in the NC Reef almost a 12% performance. A big part of that was driven by the high inflationary environment. So agriculture totally captures the inflationary component. We're mining, which is more GDP sensitive and looking towards the growth. That will capture as we come out of the cycle and we start to see more improvement, more adaptation of EVs, for example. Then we'll start to see the mining component go as we see the global economy. So mining and energy in the form of oil and gas, we typically refer to that as inflation participation. These assets basically take advantage of inflation, tend to outperform it, but coming out and into the cycle where agriculture will just plug along, capture, and be more in line with the GDP growth of the global economy. The infrastructure part of the portfolio, that the core component is the stabilizer component. Long-term contracts should be very stable relative to what happens in the economy, whether it is good or bad, has higher interest rate sensitivity because there tends to be more leverage associated with that. But that interest rate sensitivity is at the longer end of the curve. One of the risk factors that we look at is basically the duration of the loans relative to the contracts of the underlying assets. So we want to see the loan being shorter than the duration of the contract. So we have a 10-year contract, a 7-year loan is a good thing to have. If we have a 10-year contract and a 15-year loan, that's not a good thing to have because at the end of the contract, there's no guarantee that I am able to maintain the same financial levers, and I still have 5 years of uncertainty with respect to debt. That's the key thing to look at there. The non-core component, which is still being built out by the team, that takes advantage of the GDP growth as your economy improves. So as you can see, the short answer here is each component has a very specific job. And it's our job to make certain that they are performing that job. And in this case, they currently are performing those jobs. So,
Well, thank you for that. I really appreciate it.
Gotcha. All right, that's it. Great. All right, thank you.
Thank you.
Should have been for 10 minutes. Okay. So as we accelerate through items for staff review,
Nothing,
great items for future agendas,
nothing.
good of the order.
No.
Wait. Steve, you want to do it now or later? The good of the order? Later, okay, nothing.
Okay, motion to adjourn.
So move.
All right, gotcha. What's the break, Madam Chair?
Okay, thanks. So let's go ahead and take a 10-minute break. 9:30, we'll convene the meeting of the Board of Investments. Thanks.
Gotcha.
Record